Namaste, this is CA.Lakshman Jijnasu. In this video, we will discuss about India 16 that talks about property, plant and equipment. Property, plant and equipment often compromises significant portion of total assets for any entity. Hence, it is important in the presentation of financial position. Moreover, the determination of whether an expenditure represents an asset or it need to be charged to P&L can have material impact on an entity's reporting financial performance. So, considering this, the importance of robust accounting for PPE cannot be overemphasized. So, the objective of India 16 is to prescribe accounting treatment for PPE so that it can enable the users of financial statements to understand what is the entity's investment in PPE and what has been changed since the last financial year in the investment in category of PPE. So when we are dealing with the PPE accounting, there are three major issues. First is regarding the recognition that when we need to recognize PPE and PPE as an asset. So we need to recognize, we need to check each and every transaction whether it falls in the definition of PPE or we need to charge it in the P&L in the same financial year. Second category is second issue is about the measurement. So how the value of that asset PPE is to be determined. And next is depreciation and impairment of PPE. So we need to check how to allocate the cost and the record the losses. Cost in respect of the depreciation and loss in respect of the impairment of assets. So these are three principal issues. Those are catered by Ind AS 16. One is the recognition, second is measurement, and third is depreciation of PPE and impairment of it. So if we look at the hook, India 16 talk about the life story of an asset from the recognition to measurement and depreciation and later on the impairment of it. Next is there are some exclusions in respect of India 16. Otherwise, it applies on the all the assets. So exclusions are first is PP, those are held for sale. It is covered by Ind AS 105. So once the asset is held for sale, then there is no applicability of Ind AS 16. Next is the biological asset. So in case of biological assets, except bearer plants are covered in the definition of PPE. So it will be covered under Ind AS 16. So other than bearer plant, Ind AS 41 will apply. And in case of bearer stays and produce of the bearer plants, Ind AS of biological assets will be applicable. 41 will be applicable. So, in the biological assets, the bearer plants will be covered by Ind AS 16, but other than bearer plants, the produce will be covered by Ind AS 41. Similarly, exploration and evaluation assets, these will be covered by Ind AS 106, and the mineral rights and reserves. So there is no specific Ind AS for mineral rights. Different Ind AS will be applicable. So it will be covered by Ind AS 106 also at the time of exploration and evaluation before the feasibility is checked. And mineral rights, if they are in respect of the oil and gas, etc., then 38, it will cover the 38. And for development and reproduction assessment etc is 16 will be covered, and the site restoration etc if they are in respect of the mineral rights, so India's 37 and 16 will be applicable. So there is no specific particular Indias that will be applicable to mineral rights. Different categories of Indias will be applicable, and there is some special category exceptions within the exception. So the cases here we have discussed regarding the PP, held for sale, biological asset, and exploration and mineral rights. On these categories are excluded from Ind AS 16, but the assets maintained to develop or maintain these categories are covered under Ind AS 16. For example, if there is a drilling equipment that is used for the exploration. So here exploration is not covered, but the machine that is used for the exploration will be covered by Ind AS 16. But India exploration rights will be covered under Ind AS 106. Similarly, entity following Ind AS 14, investment property shall apply the cost model of Ind AS 16 for own investment property, and apart from it, in case of lease, recognition will be done as per Ind AS 17, but Ind AS 16 will be applicable for depreciation and measurement thereafter. So next is about the definition. PPE is the asset that is held by the entity for the purpose of production and service, or for rental, or for administrative purpose. Next is, and the period for which PPE is held, the item is held, is more than one period. Definition of period is not defined under India 16, but is construed to be a financial year. So if the asset that is held by the entity for more than one period, financial year, then it falls in the definition of PPE. So recognition criteria in respect of PPE is, we need to recognize PPE only if we expect that future economic benefit will flow to the organization and we can measure the cost reliably. So here the concept is that it is probable, measurable, and in that case we need to recognize it. Probability of future economic benefits and measurability of cost. In case of spare parts and standby equipments, we need to treat it as PPE when they meet the PPE definition. Otherwise, we need to book it as inventory. So standby can stand as asset if used for more than 1 year, one period. If not more than one period, in that case, we need to book it as an inventory. So in case of spare parts, India 16 provides that it will fall in the definition of inventory. India 2 is silent about it. Next is, we need to use the unit of measurement is based on the judgment. We need to combine some assets to make one PPE. So here we need to use the judgment to decide the level of aggregation of the assets. For example, if there are multiple jigs, so we may combine those jigs and to create one asset and evaluate cost as incurred. So whenever a cost is incurred, we need to assess each and every cost at initial level and subsequent level that is related to the fixed asset, whether we need to book it as an addition, or we will book it as a replacement, or will be booking that transaction as a normal service transaction. So each and every transaction we need to judge if it falls in the definition of PPE and it is in nature of addition or replacement or normal repair and maintenance. So we need to judge each and every transaction. There may be some cases where the flow of the assets, PPE, or flow of the transaction is not directly coming to the organization, but to run the organization or to run the activity, we are supposed to do that investment. In that case, India 16 says that we can capitalize it. For example, in case of the safety and urban environmental items, we need to capitalize it if they are enable other assets to generate benefit. For example, if there is any requirement from the government to establish a machinery to create curb on the pollution. In that case, although the economic benefit of that machine is not going to directly flow to the production activities of the organization or the sale of the organization, but to continue the manufacturing activity, that investment of machinery to curb the pollution is necessary, because without that I cannot run my production facility. So in that case, India 16 says that we can capitalize these assets. Next is, if there is a day-to-day servicing. So routine repair maintenance expenses, we need to expense them immediately. So the expenditure those incur to keep the asset alive are not a new life of the asset. So we need to expense it off. Similarly, in case of the replacement, we can capitalize a new part if criteria of PPE is met, and we need to remove the old parts book value from the value of the PPE. So replacement is equal to remove the old value of the old part and add the value of the record the value of the new part that we have capitalized. There are some industries where major inspection are necessary to continue the asset in the operation. For example, in case of the airlines, major overhauling and inspection is required to run the aircraft. So in that case, India 16 says that this inspection cost we need to treat as a replacement cost, and we need to recognize the inspection cost as an addition and should de-recognize the previous inspection that we have booked. So there are two things. We will recognize this inspection, those are required to carry the assets in the operation as an addition to the asset, and we will de-recognize the earlier inspection value from the value of the PPE. So each inspection is a new ticket. We need to check and treat it as given in the standard. So let's take one example of major inspection. For example, there is a aircraft that we purchased for a value of 10 crore on April X1, and this cost includes 50 lakhs that is related to initial major inspection needed to make aircraft operational, and the inspection is required every 5 years. The inspection cost is depreciated over 5 years because this inspection is required for every 5 years. And on April X1, a new major inspection is performed at a cost of 60 lakhs. So we will do the accounting at the time of acquisition. We will recognize the PPE with a value of 10 crore, PPE debit to cash and bank, and depreciation for inspection component 50 lakhs, 10 lakh per year we will depreciate the inspection cost, and at March X1 accumulated depreciation on inspection will be 50 lakhs because in every 5 years we need to do the inspection. So the value of the life of this inspection will be 5 year, and at the end of 5 year the value will be zero. So when we'll be performing new inspection in X6 at a value of 60, so we'll recognize it as a separate asset. So we'll debit the PP inspection component 60 lakhs and to cash or bank 60 lakhs, and we will de-recognize the earlier asset that we have booked. So we will debit the accumulated depreciation to the asset, this 50 lakhs. So we'll do two things. First, we will de-recognize the asset, and we will recognize additional asset for next 5 year inspection asset 5 year. For example, we take another situation where the replacement cost occurred after 4 years instead of 5. The scheduled maintenance was after 5 years, but it has to be done after 4 years because of some reason. In this case, the book value of the 50 lakhs, because only 4 years have been passed, so book value remains 10 lakhs, 40 lakhs has been depreciated. So in this case, we need to de-recognize, we book a loss of 10 lakhs at the time of de-recognition of the asset. So we will debit the accumulated depreciation of 4 years, and we will debit the loss with the book value of the asset, and the asset will be credited. It will be de-recognized. So in the case of major inspection, we need to treat it as a replacement cost. We need to de-recognize the asset from the books, and we need to recognize a new asset. Next is about the basic measurement rule. An item of PPE that qualify for recognition shall be measured at cost on initial recognition. So recognition is recorded at cost, and cost component will be purchase price, that is net of discounts and rebates. Cash discount we will not cover here. We will not deduct from the cost of the asset because those are not related to bring the asset to their present and condition. They are having the nature of financial element, so we will not deduct it. And we will include the directly attributable cost to bring the asset to working condition and location, and initial estimation of dismantling and restoration we need to cover as per NDS 37. Here it means that if we are having we have bought an asset, we have acquired an asset, and there is a liability to restore or dismantle something at the existing asset that we have acquired. So we need to estimate the cost of dismantling and restoration at the end of the useful life of the asset, and we need to create the add that present value of that liability in the book value of the asset. So we will discuss it in detail at the time of discussion of appendix of India 16. There are some examples of directly attributable cost, that employees benefit, site preparation, delivery, installation, testing. And if there is at the time of testing, we have used some material. For example, to check whether machine that we have installed is functioning as per the intention of the management, we need to prepare some uh, demo products. So the material used to create those demo products will be added as a cost of the machinery. And if we have sold those machinery, or if there is a scrap value of the material that we have used, sorry, so that value we need to reduce from the realizable value of those products, or the scrap we need to reduce from the value of the PPE. So there are 5P rule. We need to add the value of people, preparation, place, and testing, and any restoration obligation if anything is there, professional value. But in case of the employees benefits, these are included only when they are directly attributable to bring the assets in the present location and condition. Otherwise, employees benefit are considered as a general administrative overhead and are not included in the value of PPE. Costs those are not to be included are those are not directly attributable to bring the assets to use, such as administration and general overheads, advertisement, promotional costs, staff training cost, initial operating losses, etc. We are not going to include. So the hook is, if the cost that we have incurred doesn't make it ready to use, we are not going to include it in the value of the PPE. So key idea is that all the initial cost, all the expenditures till the asset is ready to intended use is covered under the cost of PPE. There may be some cases where we have purchased and machinery and that is on the deferred payment term. So if the machinery that we have purchased is on deferred payment terms and the cash price is different, in that case, we need to recognize asset with the value of the cash price of the machine, PPE, and we should recognize the interest as a finance cost over the period unless capitalized as per Ind-AS 23, that is borrowing cost. So the logic is that credit we need to check whether it has the element of finance. So if it is having the finance element, we need to remove it from the cost of PPE and should book it as an interest of finance cost unless it is to be capitalized as per the borrowing cost in Ind-AS 23. So let's take one example. On April X1, an item of property is offered for sale at 10 million with the payment term being three equal installment, 33 lakhs over a period of 2 years. Payment are made on April X1 X2 and X3. Implicit interest rate of 5.36% per annum is there. We need to pass the necessary journal entry for recording the property in accordance with Ind AS 16. So in this example, we have given the price that is on credit, and considering that we have to pay the cost and installment in 3 years, it is assumed that it is having the financial element in it, and the rate of interest is also given here. So we need to first calculate what is the cash price of this machine. We have given the interest rate, so we need to we need to calculate the discounting factor at the rate of 5.3%, and we have come across that present value of this 1 crore is 95 lakhs. So now we need to calculate the interest expense on 95 lakhs at the rate of 5.3%, 5.36%. So there will not be any interest element in the first installment because it is paid at the time of purchasing it. So opening balance of asset that we have calculated, present value of the machine is 95 lakhs, and there is no interest element. So total payment is this. So it is considered as a payment of principal. So closing balance will be 61 lakhs 66,000. And next year, as we have paid next installment of 33 lakhs after a period of 1 year. So it is having the interest element. So we have calculated the interest element here. So it is 33 lakhs, 3.30 lakhs, and total payment is this 33 lakhs. So principal amount will be 30 lakhs. So the closing balance of principal amount will be 31 lakhs, and on 31 lakhs, there will be interest liability of 5.36%. Again, we need to calculate and we need to book it as a interest expense, and we need to calculate the principal amount separately. So on X1, there will be accounting entry with the present value of the cash consideration that we have calculated. PP will be debited and to bank and to account payable with a value of 61 lakhs, because first installment we paid of 33 lakhs and there is no interest element, so we will reduce this amount from the liability, and we will, for differential amount, 95,000 minus 33 lakhs we will create for the account payable. And in next year, on March X1, we have paid again 33 lakhs, and it is having principal component of 30 lakhs and 3.3 lakhs of interest component. So similarly, we have recognized the interest expense of 3.3 lakhs. We have debited the liability that we have created by 30 lakhs because the principal component is of 30 lakhs and bank 33 lakhs. In next year, we have again paid 33 lakhs, so we have credited the bank with 33 lakhs, and the interest component that we have calculated is 1.69 lakhs, and the principal that we have calculated is 31 lakhs. So we will debit the liability by 31 lakhs, and we will debit the interest expense by 1.69 lakhs. So interest expense debit, accounts payable credit, or sorry, debit account, interest expense debit, account payable debit, because we have paid the amount, and to bank. So this will be the treatment of finance cost under Ind AS 16. So if next is in next principle is in respect of the exchange of the asset. So if an entity has exchanged an asset, so we are going to measure it at a fair value. The PPE that we have acquired, we are going to measure it at a fair value unless the transaction lacks the commercial substance, or fair value cannot be really reliably measured. Because if you check, there is a first condition that the PPE will be recognized only when it can be reliably measured. So when we are measuring based on the fair value, we need to check whether it is having commercial substance, or the fair value that we at which we are going to recognize it can be reliably measured. If the fair value of acquired asset cannot be reliably measured, in that case we need to use the carrying amount of the asset that we have given up. So there are two things. First, we need to check what is the fair value of the asset that we have acquired. And if we cannot measure reliably the fair value of the asset acquired, in that case, we need to check the carrying amount of the asset that we have given up. So let's take one example that is given in your study material. Pluto Limited owns land and building which are carried in its balance sheet at an aggregate carrying value amount of 10 million. The fair value of such asset is 15 million. So carrying amount is 10 million. The fair value of this asset is 15 million. It exchanges the land and the building for a private jet which has a fair value of 20 million. So the carrying amount of asset is 10 million, fair value of our asset is 15 million, but we are exchanging with a private jet that is having fair value of 20 million, and we are paying additional 3 million in the cash. So apply necessary provision of India 16 for the above transaction and pass journal entry for the same. So here there are three scenarios. First is fair value of the asset received, that is 20 lakhs. This we need to use when exchange has commercial substance and fair value can be reliably measured. Because there are two conditions that we have discussed earlier, that PPE acquired in exchange for another asset is measured at fair value unless transaction lacks commercial substance or fair value cannot be reliably measured. If both the conditions are satisfied, the acquired asset is having the commercial substance and fair value can be realized, measured reliably. In that case, we need to use the fair value of PPE acquired. So in this case, if we take assumption that it is having commercial substance and fair value can be reliably measured, in that case, we will take the fair value of the asset received acquired. So in this case, we will consider 20 lakhs. There may be another situation if the carrying amount of asset given up and cash. In this case, it comes 13 lakhs, 10 lakhs plus 3 lakhs. And this will be used when there is a no commercial substance or fair value cannot be reliably measured. Another is if the fair value of asset given up is more reliably measured. So in that case, we will use the fair value of assets that we are given up plus cash. So there are three conditions, three options are there for the accounting of that. So let's check. In case of option 1, the exchange has commercial substance and the fair value of asset received is reliably measured. This is we are assuming. Therefore, the cost of jet is measured at 20 million fair value and we need to remove the old asset that is at carrying value of 10 lakhs, 10 million, and the difference we need to book as a gain in profit and loss account. So amount of gain will be fair value of jet 20 lakhs minus cash that we have paid 3 lakhs minus carrying amount of assets given up. So ultimate profit will be 10 lakhs. Because we have purchased the asset of 20 million, against this we have given 10 lakhs asset that is having carrying value of 10 million and cash element of 10 million. So there is a profit of 7 million. So we will debit the property, plant and equipment that is jet by 20 million. We will credit the land and building. We will it means the derecognition of it by 10 million, and we will credit the cash by that we have paid by 10 million, and there will be recognition of gain on disposal of PPE that is of 3 million. Similarly, in the study material, they have used the third option where they have considered that fair value of asset given up is more reliably measured. So in that case, the profit on exchange of asset will be changed. So recognition of fair value of asset will be 15 million plus 3 million, that is 18 million. And then we will de-recognize the asset by 10 million, then cash paid by 3 million. So profit on the exchange of asset will be 5 million. So in that case, accounting entry will be private jet debit to by 18 million and PP 10 million to cash 3 million and profit on exchange of the asset 5 million. So by whatever way we are solving this question, if an assumption is not specifically given in the question, that we need to explain the assumption that we have taken and need to solve the question accordingly. Next is about the self-constructed asset. So if an entity construct its own PPE, so we need to use the same cost principle as for the purchased asset we have used. So in this case, we need to include only the direct material, labor and attributable overheads, and we need to eliminate internal profits and expenses for the abnormal waste. So in case of self-made, same rule, no profit, no waste. On that basis, we will book the cost of the asset. For example, there is a company that is manufacturing air condition, and for its office function, it is required to have 10 air conditioner. So in this case, it will be considered as a self-constructed asset, and whatever is the cost of manufacturing one air conditioner will be considered as a cost for the self-constructed asset, for the cost of those air conditioner to capitalize. There may be a case where the air conditioner division is selling the air conditioner to the different division in the same entity at a markup price. So while capitalizing, India says that we need to eliminate internal profits. So we will eliminate the internal profit and we will book the asset with the cost of the asset to manufacture it. Next is about the bearer plants. As we have seen that bearer plants are covered by Ind AS 16 and their produce is covered by Ind AS 40. So 41, sorry, agriculture Ind AS. So we need to account for same as the we have used in the self-constructed asset in case of the bearer plants also, and whatever expense we have done to create the bearer plant, to necessary to cultivate the bearer plant, the all the cost we need to add in the cost of the bearer plants, and the produce we will cover as per Ind AS 41. So there is choice of methods. Their entity may use the cost model or it may use the revolution model for accounting of PPE. So in case of cost model measurement, we need to carry the asset at the cost minus accumulated depreciation minus accumulated impairment loss if any is there. So, but in case of revaluation model, we need to carry the asset at the revalued amount, and revalued amount is fair value at the date of the revaluation minus depreciation minus impairment. And in case of revaluation model, if we are using, we need to revalue the assets on a regular basis. That is required to ensure that carrying amount is equal to the reporting a fair value at the reporting date. So there is no frequency decided, but we need to check the how much frequency we need to check about the fair value, whether about the revaluation value that we are carrying as a carrying cost of the PPE, whether it is equal to the fair value or not. There may be a category of some assets where frequent revaluation is required, and there may be some category of the assets where frequency of revaluation may be lesser. So whenever we are applying the revaluation model, we need to apply it on a whole class of PPE. It should not be applied on the selective assets. So it will be on the class of PPE. It is not required to do for the all PPE. There may be a specific classes for which we need to do the revaluation, but it should not be for the selective assets. In case of revaluation model, there may be different model that we can use. We can for the booking of it, there are two methods. One is we need to reinstate the carrying amount and accumulated depreciation proportionately for the impact of revaluation. And second method is eliminating the accumulated depreciation against the gross carrying amount. So both method we can use for the booking of the revaluation impact on the PPE. So ultimately results is more or less the same. So if there is a upward, we will discuss it with the example in few minutes. In case of there is a upward revaluation, we need to recognize it as a revaluation reserve unless it reverse a prior decrease in the profit and loss. So if there is a upward, we need to book it in OCI. And if it is downward, again, we need to book it in P&L, except to the extent of existing surplus is there for some assets. Then we need to adjust in OCI. So if there is a decrease, we need to book in P&L. And if it is against the revolution reserve that is there in the amount is there in the reserve, so we need to adjust it with the existing reserve balance. And depreciation after the revaluation, it will be charged on the revalued amount minus the residual value over the remaining useful life. And we, at the time of revaluation, surplus we need to transfer to the retained earning when the asset is used in form of depreciation, or company may use to transfer, company may opt to transfer the revaluation reserve at the time of the asset is fully depreciated or on its disposal. So this is accounting policy choice. Either company can opt to transfer the revaluation reserve amount to the retained earning at the as the asset is depreciated, or when it is disposed of at that time also it can transfer. So in for the disclosure, we need to disclose valuation methods that we are using, and whether we are using cost model or revolution model, that we need to disclose, and frequency of revolution, involvement of valuer, and movement in the revolution surplus we need to disclose in the books of accounts. So let's discuss about few examples about the revaluation. Jupiter has an item of PPE with an initial cost of 1 lakh. At the date of revaluation, accumulated depreciation amount for 55,000. The fair value of asset by reference to the transaction in similar asset is assessed at 65,000. So we need to pass the journal entry. So there are two methods that we have discussed. First is depreciation elimination approach, and second is proportionate restatement of gross and accumulated depreciation. So by the both way we will learn how to account it for. So let's summarize that cost of asset, the book value of asset is 1 lakh. Accumulated depreciation at the revaluation date is 55,000. It means the book carrying amount is 45,000. Sorry, the gross carrying amount was 1 lakh. Acquisition cost was 1 lakh. Accumulated depreciation at the revaluation date was 55,000. So carrying amount book value was 45,000. 1 lakh minus 55,000, that comes around 45,000. And fair value that is given is 65,000. So there is an increase in the valuation of the asset, and the increase is by 20,000. So first method was eliminate the accumulated depreciation against the asset, then raise the asset to its fair value. So this is a common approach. So accumulated depreciation was 55,000. So we need to write it out. So we will debit the accumulated depreciation and we'll credit the asset. So now the gross asset come down from 1 lakh to 45,000. 1 lakh, and we have credited asset by 55,000 by the amount of the accumulated depreciation that we are having. So it comes down to 45,000. So accumulated depreciation is 0 and the carrying amount of asset is 45,000. But in question that it is given that we need to increase it to 65,000. So in this case, we will debit the asset with a gap of 65 and 45,000. So we'll debit the asset by 20,000 and revaluation reserve we will credit by 20,000. So now asset will be having the balance of 65,000. 45,000 carrying value it is having after removing the 55,000 accumulated depreciation, and we will add the revaluation surplus we have added here. So total amount comes to 65,000. Another method is proportionate restatement of gross and accumulated depreciation. So instead of removing the accumulated depreciation, we proportionate restate value of the asset also as well as the depreciation also. So in this case, we compute the scale factor. How much percentage the amount has increased? It has increased by 1.44%. So this is calculated by revalued carrying amount divided by old carrying amount. So the new gross carrying amount, if we multiply with this factor, will come about this 1,44,000. And similar way, the new depreciation will, new accumulated depreciation will increase by new gross carrying amount minus the existing balance, sorry, revalued amount. So it will increase by 79,000. So increase in gross asset is 44,000 and increase in accumulated depreciation is 79,000 minus existing value in the depreciation, that is 55,000. So we need to increase the accumulated depreciation by 24,000. So net increase will be 44,000 in the book value of the asset and 24,000 in the accumulated depreciation. So revaluation surplus will be increased by 20,000. So here we will debit the asset by 44,000. We will accumulate the depreciation by 24,000 and revaluation surplus we will increase by 20,000. So these are the two methods of any one of them we can use based on the accounting policy choice of the company. One is the depreciation elimination method and second is proportionate restatement of gross and accumulated depreciation. Next is Venus Limited is a large manufacturing group. It owns a considerable number of industrial buildings such as factories and warehouses and the office building in several capital cities. The industrial buildings are located in the industrial zone where the office buildings are in central business district of the city. So the manufacturing group is having buildings and there are two categories. One is it is in industrial zone and another is in business district. Venus Limited Management wants to apply the India 16 revolution model to subsequent measure of the office building but continue to apply the historical cost model to the industrial building. So it is asking us whether this accounting treatment to be applied by the management is in light of India 16. So as we have seen that when applying the revolution model, we can apply the revolution model for the class of the asset. So India 16 permits asset to be revalued on class by class basis. So here there are two classes. One is of industrial building and another is of office building. So management wants to revaluate the industry building only. So it is allowed because it is a separate class of the PPE within the entity. So it is allowed. Next is utilization of revaluation surplus. An item of PPE that was purchased for a value of 9 lakhs on X1, it is estimated to have a useful life of 10 years and is depreciated on SLM basis. On X3, the asset is revalued to 9 lakh 60,000. The useful life remain unchanged as 10 years. Ignore the impact of deferred tax. Calculate the depreciation and revaluation surplus for X3, X4 as per Ind AS 16. So the fact is the cost of machine is 9 lakh. Useful life 10 years and we are using SLM method. And annual depreciation before revaluation was 90,000 per year depreciation because the life of assets is 10 years. So 9 lakh divided by 10, 90,000 per year we are using and 2 years have passed till April X3. So we have already booked depreciation of 1 lakh 80,000. So if we calculate the carrying book value on X3 before revaluation, it comes down or comes to 7,20,000. So revaluation amount is given 9,60,000. So increase in revaluation is by 2,40,000. So this is a revaluation surplus. So remaining life, useful life after 2 years remain 8 years. So 9,60,000 we need to book in 8 years. So per year depreciation will come to 1,20,000. So general entries will be to eliminate the accumulated depreciation. In this case, we will debit the accumulated depreciation that was 1,80,000 2 years depreciation, and we will create the asset by 1,80,000. So this will bring the accumulated depreciation to zero and the asset carrying amount to 7,20,000. Now we need to revalue it at 9,60,000. So we need to increase the carrying amount, that is 7,20,000 to 9,60,000. That we need to increase. That means that we need to increase the value of the asset by 2,40,000. So we will debit the asset by 2,40,000. We will credit the revaluation surplus by 2,40,000. So after step one, that is elimination of the accumulated depreciation, and step two, that is about the increase in the depreciation, our gross net book value will be 9,60,000 and revaluation surplus will be 2,40,000. That will be held in equity as a OCI. So if company opt an option to transfer the asset to the extent of depreciation charge on yearly basis, in that case, here the additional depreciation, earlier depreciation was 90,000 and after revaluation the depreciation has come to 1,20,000. So there is an additional depreciation of 30,000. So we can offset it with the revaluation surplus. Another option is company may opt to choose at the time of disposal. So if we take an example, if we opt to offset it on a yearly basis, then we will debit the revaluation surplus by 30,000 and we will create the retained earning by 30,000. So this entry is optional. Many companies make it annually to gradually transfer the surplus as the asset is used. If they don't, then full surplus 2,40,000, that is remains in revaluation surplus until the asset is disposed, and only then it is transferred in one go. So there is an option to transfer it. Whatever way we can transfer it, we can decide. So next is about the component accounting. So if there is a significant part of any PPE where the cost is significant to the total cost of the asset, in that case we can depreciate it separately. So there may be different useful life for separate depreciation for that part, and in respect of the significance, it is not defined in the Ind AS. We need to use the judgment, we need to use the accounting policy at what level we will consider it as a significant. So if there is a component that is having the significant value and the life is more than one period, in that case we can opt the option of the component accounting and we can recognize it as PPE and can depreciate it separately. And the depreciation cost, depreciable amount shall be allocated on a systematic basis over its useful life, and depreciable amount is cost minus the residual value that we need to estimate, and depreciation is a systematic allocation of the cost. And depreciation begins when the asset is available for use, not when it starts producing. There may be gap between the start of production and available for use. If the asset is available for use but is not being used, so we need to depreciate it. So depreciation will be when the asset is available for use, and it will cease when it is de-recognized from the books of account or it is classified as held for sale as per Ind AS 105. So in this case we need to sees the depreciation booking. If the asset is idle, in that case, although the asset is idle, but depreciation will incur. Depreciation will not cease when the asset is idle. It will cease only in case when the asset is derecognized or it is classified as held for sale. And next is about the useful life and residual value of the asset. We need to review the useful life, residual value, and depreciation method at least financial year, and to check whether it is giving the correct results, and if there is any change need to be made, it is considered as a change in the estimation if the expectation differs from the previous estimate. Entity needs to choose a method for reflecting pattern of consumption of future economic benefit from the assets that we have capitalized. So there are three methods that have been given. Entity may use the straight line method or diminishing balancing method or unit of production method. And whatever method we have used, we need to apply it consistently. And if there is a change in the method of depreciation that we have used, it will be considered as a change in estimate and will apply prospectively. For example, an entity acquired an asset 3 years ago at a cost of 5 million. The depreciation method adopted for asset was 10% reducing balance method. At the end of third year, the entity estimate that the remaining life is 8 years. And determine to adopt the SLM method from the date so as to reflect the revised estimated pattern of the recovery of the economic life. Calculate the depreciation charge for the respective year in accordance with Ind AS 16. So in this case, the company estimate that after 3 years, the remaining life of the asset is 8 years more, and it wants to change from diminishing balancing method to the SLM method. So first we need to calculate what is the book value at the end of the 3 years. So change in the depreciation method shall be accounted for as a change in the accounting estimate in according to Ind AS 8, and hence will have prospective effect. Whatever value remaining life remains, it will be depreciated in the remaining useful life, that is 8 years. So depreciation charge for the year 1 to 11 will be as follows. So year 1, that is 5 lakh, 5 million at a rate of 10%, and the remaining value will be 45 lakhs, and on this 10% will be charged, that is 4 lakh 50,000. And after reducing 4 lakh 50,000 from the balancing figure, it will remain 40 lakhs 50,000. And on third year it will be calculated on 40 lakh 50,000. So the depreciation will the carrying amount will be 30 lakhs 45,000. So we have calculated the book value in the beginning of fourth year. Now, at the beginning of fourth year, company changed the policy and it says that the remaining life is 8 years, and it is going to use the SLM method. So we will simply divide the 30 lakhs 45,000 divided by remaining useful life 8 years. So as we know that we need to use the prospectively the impact we need to take. So the 3645 lakhs will be divided by 8, and 4 lakh 55,000 depreciation will be charged for the remaining period. Next example is MS Limited has acquired a heavy machine at a cost of 1 crore with no breakdown of component part. The estimated useful life is 10 years. At the end of 6 years, one of the major component, the turbine, require replacement as further maintenance is uneconomical. The remainder of the machine is perfect and is expected to last for next 4 years. The cost of new turbine is 45 lakhs. The discount rate assumed is 5%. Analyze whether the cost of new turbine can be recognized as an asset, and if yes, then apply the accounting treatment to relevant. So, we have learned the component accounting. If there is a significant part of the PPE that is significant in relation to the total cost of the item, so we can capitalize it. So, the answer says the new turbine will produce economic benefit and cost is measurable. These are two conditions to recognize as a PPE. Hence, the item should be recognized as an asset. The original invoice for the machine did not specify what was the cost of the turbine because the turbine cost is already included in the value of 1 lakh. But the examiner has given a discount rate of 5%. So we will calculate the appropriate discount rate is there. So we will calculate the value of the turbine based on this rate. So it comes down 33 lakhs 57,000. So the current, if we calculate the depreciation on this amount, the current carrying amount becomes 13 lakh 46,000. So we will de-recognize this value from the books of accounts, and the cost of new turbine we will add to the cost of the machinery as a revision of the carrying amount of the machine. So 40 lakhs minus 33 lakhs 14,000, that is the carrying amount of the existing machine, plus 45 lakhs. So total carrying amount will be 71 lakh 56,840. So original cost of the machine was 1 crore reduced by the accumulated depreciation is till the end of the year is 60 lakh. So here to add the value of new turbine, we need to determine what would have been the cost of this turbine at the inception when the machine was acquired. So we need to estimate the amount that is included in this cost. So as we can, if amount is not given, but interest rate is given, so we need to discount it, and we need to reduce the amount depreciated. So carrying amount depreciated and the carrying amount of the turbine value we need to remove from the asset, and we need to add the new value of the turbine in the existing asset. Next is on April X1, XYZ Limited acquired a machine under following terms. The list price of machine was 80 lakhs, import duty 5 lakhs, delivery fee 1 lakh, electrical installation cost 10 lakhs, pre-production testing 4 lakhs, and the purchase of 5-year maintenance contract with the vendor, that is 7 lakhs. In addition to the above information, XYZ was granted a discount of 10% on the initial list price of the asset and a settlement discount of 5%. If the payment for the machine was received within 1 month and XYZ paid for the plant on 20th April, that is within 30 days it paid, so it is eligible for 5% discount also. So we need to compute the cost to be recognized. So in case of the cost, we have to include all the costs that are directly attributable to bring the assets to its present location and condition. So here, if we check, the list price of the machine is 80 lakhs. Out of that, there is a trade discount, so we need to remove it. So we comes at the 72 lakhs. Then we need to add the import duty because it is not recoverable. Custom duty is not recoverable, and delivery fees we need to add, electric installation cost we need to add, pre-production testing we need to add, and purchase of 5-year maintenance contract. This is not a cost of machinery. So 5 years maintenance contract we need to recognize as a prepaid expenditure and need to expense it off in next 5 years. It will not be part of the asset. Apart from it, trade discount we have already removed, and there is a 5% cash discount as we have paid the amount within a period of 30 days, but we are not going to reduce this amount from the value of the asset because the cash discount is considered as a cost of finance. So it is not necessary to bring the asset to present location condition, but it is provided to settle the liability before the due date. So we will not deduct this amount. So we will not deduct one the cash discount, and other that are we going to reduce is the trade discount. So the value will be 92 lakhs. Next is X Limited started construction on a building for its own use. The following costs are incurred. The purchase price of land is 10 lakhs. Stamp duty, this we will include in the cost of the asset. Architect cost, yes. Site preparation, yes. Material cost, yes. Direct labor cost we will include, and general overhead are there. So other relevant information, material costing 1 lakh has had been spoiled and therefore wasted, and a further of 1 lakh 50,000 were spent on the faulty design work. So this is a wastage amount that we are not going to include in the value of the asset, because abnormal cost we reduce. We do not consider. As a result of these problems, work on the building was stopped for 2 weeks, and it is estimated at 22,000 of labor cost related to that period. This is also because of the abnormal cost. The building was completed on X1 and bought in use on April X1. So the asset was ready on January X1. It was, we were not using the asset and we started to use on April X1. So depreciation, as we have discussed, it begins when asset is available for use. So asset was available for use on X1, January X1. So we'll start depreciation from this day. X Limited had taken a loan of 40 lakhs on April X0 for construction of a building. The loan carried at an interest rate of 8% and is repayable on April X2. Assume that entity did not consider the construction period as a substantial period of time as per NDS 23. So if it is not considered as a construction period is not considered as a substantial period, so as per NDS 23 we are not supposed to include the cost of the finance as a cost of the asset. So here we have considered cost, those are directly attributable: purchase of land, stamp duty and legal fees, architect fees, site preparation fees. Material we have reduced by the cost of the abnormal wastage. Similarly, the additional labor cost, because of this wastage, plant was closed for 2 weeks, we have reduced here. General overhead are not included. Interest, as we have discussed, this is not a substantial period. It is given in the answer, so we are not going to include it. So the total capitalization amount will be 45 lakh 78,000. That is exclusion of general overheads, interest, and wastage of abnormal wastage of material and direct labor cost. So next is about the land and buildings. Land and buildings are separable assets. So land usually has indefinite life. So there is no depreciation unless it has limited useful life. So land will be depreciated only when it has limited useful life. For example, if there is a lease of 99 years, in that case we need to depreciate the asset in 99 year. And if there is land subject to legal or regulatory expiry, in that case we need to depreciate it. Another example may be if land is used for industrial waste, for example, disposal, chemical treatment, etc., and contamination is there that will make asset land unusable or required to restore after at the closure of it. So we need to depreciate it if there is a boundation of time period. And in respect of maintenance versus overall, we have already discussed that routine maintenance expenses we need to expense it off, and major overhaul we need to uh, capitalize and depreciate it separately, as we have discussed in case of the aircraft maintenance example. And in respect of depreciation, there are some disclosure requirements that we need to disclose the depreciation method used, the useful life and rate that we have used for the depreciate the PPE, gross carrying amount and accumulated depreciation, and reconciliation of carrying amount opening versus closing. What are the impact, maybe because of the disposal of the assets and end of useful life or whatever it is. And if there is a change in the method of depreciation, etc., then we need to disclose it. So next is derecognition. We will derecognize the asset when at the time of disposal of asset, or if we estimate that there is a no future economic benefit is there, so we need to derecognize the asset. And the disposal value, we need to book the gain or loss, and it is calculated by reducing the carrying amount from the net disposal amount, and it will be recognized in P&L. And it is not classified as revenue because it is not an ordinary activities of the entity, so it will be recognized as a non-operating expenses. Mode of disposal, maybe if we sell the asset, if we scrap the asset, or if we terminate the financial lease, all are included as a considered as a disposal. And there may be a replacement scenario when a part is replaced, as we have discussed in the turbine case example. So we need to de-recognize the old part that value is we have included in the earlier asset. And in case of exchange disposal, we need to follow the measurement principles that we have discussed earlier. So if there is a change in the existing decommissioning, restoration, or similar liabilities, so there is an appendix given in the Indias. So when an entity acquire or construct an item of PPE, it may also incur future legal or constructive obligation to dismantle or remove the asset or restore the site. For example, an asset is provided to entity, but there is a condition with the agreement that the entity need to restore the asset in a particular condition. So there is a constructive obligation. So to dismantle or remove the asset or restore the site. So in that case, the entity need to incur some expenses. So whatever the future expenses we are going to incur, so that transaction will be considered as a liability at the date of the acquisition of the asset. So the present value of the future obligation, we need to add in the cost of the asset at the initial recognition, and the provision need to recognize as per Ind AS 37. So later, if there is a change in the estimate at the time of, for example, timing of the settlement is changed, discount rate that we have used to measure the present value of the liability has changed, or the amount of expected outflow has increased. So we need to consider it. So there are three, four scenarios in this respect. If that asset is measured under cost model, so in that case, we need to adjust the carrying amount of the PPE for any change in the liability because of these factors: timing of settlement, discount rate, or expected amount of the outflow. So in this case, we will increase the provision and will add it into the assets cost. And if there is a decrease, that we in that case we will decrease the provision and will deduct from the assets cost. So cost model change follows the asset. And if decrease in liability is greater than the carrying amount of the asset, if the amount of liability that has decreased is greater than the carrying amount of the asset, in that case we need to reduce the asset carrying amount to zero, and the remaining amount whatever is there we need to book it as a gain because the liability has been abolished. So we are not going to make asset negative. So whatever is the remaining amount of the reduced liability, we will book it in P&L. Next is if the asset measured under revolution model. In that case, if liability is increased, we will debit the OCI or the P&L if excess of the surplus is there. And if there is a decrease, we need to credit the OCI and vice versa P&L or P&L. And depreciation adjustment after the adjusting cost of the asset, we need it will be depreciated in the remaining useful life as usual. For example, H Limited purchase an item of PPE that is costing 100 million, which is having useful life of 10 years. The entity has contractual decommissioning and site restoration obligation that is estimated as 5 million to be incurred at the end of 10 years. So PPE that we have purchased is at 100 million and there is a restoration obligation of 5 million that is at the end of 10 years. The current market base interest rate is 8%. Company follow the SLM method. H Limited follows the cost model for the PPE, determine the carrying value of PPE and decommissioning liability at each year end, and when there is a no change in the expected decommissioning expenses, expected timing of incurring the decommissioning expenses and discount rate. So first we'll look at the question and we'll solve it by option A, then we will solve it by option B. So in this case, below are the facts. The cost of PP is 100 million and decommissioning liability is expected at 5 million at the end of 10 years and discount rate is 8%. Useful life is 10 year. Depreciation method that we are using SLM. So the model under which we need to do the adjustment is the cost model. So in this case, first step is we need to initially recognize the PV of decommissioning liability. So 5 lakh at the end of the 10 years by rate of 8%. So PV come 2.316 million. And initial entries at the equation will be PPE with the value of 100 million of the asset plus the value of the decommissioning liability. So it is 2.316. So it comes 100 plus 2.316, 102.316 million by the cash 100 million. And for this, we will recognize liability 2.316 million. Step 2 is depreciating and unwinding 1 year onward. So annual depreciation will be 102.316 and the life is 10 years. So it will be 10.232 million per year. So this is unwinding of the liability. Opening liability this and interest rate is this. The closing liability is like this. So it will be increasing year by year and will come to 5 million at the end of 5 years. So step 3 is year end journal entry. So at the end of the year, depreciation on P will be debited by 10.232. This we have calculated here. And it will credit the accumulated depreciation. And for the finance portion, interest portion 0.185, we will debit the finance cost and we will reduce the decommissioning liability. So in case there is a no change in the estimate, we need to continue like this. We will book the depreciation and we will book it as a accumulated depreciation credit and we will do the unwinding of the discount. We'll debit the finance cost and we'll credit the decommissioning liability. Next was that at the end of 4 years, the entity expect that the estimated cash flow on account of decommissioning and site restoration to be incurred at the end of the useful life of the asset will be 8 million instead of 5 million. So we need to change our estimate because it has increased from 5 to 8 million. So now at the end of the 4 year, expected cash flow increase from 5 to 8 million, but it is still payable at end of the 10 years. So we must remeasure the liability using 8% discount rate. So the liability comes to 5.042. PV of 8 million after due after 6 years come down to 8. Existing carrying value of liability is 3.15 interest that increase that is required is 1.892. So we will increase the value of the asset by 1.892 as well as increase the decommissioning liability 1.892, and the depreciation will be booked prospectively. So the remaining useful life PPE carrying amount before adjustment. So we have booked the depreciation of 4 years. It comes down to 61.388, and there is a new addition of 1.892. So the new carrying value will be 63.283, and the new acquisition remaining useful life is 6 years. So we will book this 63.280 in the remaining 6 years, that is 10.547 million. So this is about the change in existing decommissioning and restoration of similar liabilities. And there is one more appendix B is given, that is about stripping cost and production phase of surface mine. So the purpose objective of A is to explain how a mining company should account for the stripping cost. Stripping cost means the waste removal cost that is to be incurred during the production phase. Production phase is period after the mine is operational, and production is and producing sellable out. So stripping activities is a waste removal cost, and production phase is when the mine is producing sellable out. So if stripping cost is there during the production phase, that it explains us how the accounting to be done. So in this case, the deferred asset we will recognize when stripping improves the access to the ore to be mined in future period. So it will be divided in a two categories. One is a current benefit related to ore extracted now. So it will be a part of the inventory cost, and the future benefit we will book it as an asset. Stripping activity asset we will book. And this asset will be recognized as the recognition principle of the asset PPE, that future economic benefits are there, cost can be measured reliably, and the identifiable component of ore body exists and will be benefited. So if three P's are there, if it is probable, if it is priced, it can be measured reliably, and part is identified, is identified, that will be benefited. So in that case, we can recognize the asset. So initial measurement that we'll do at cost, that is directly attributable to stripping cost. Typical cost includes labor, fuel, depreciation of mining equipments, etc. And we will allocate this total cost, stripping cost, in current and future benefit. So current cost will book it as a inventory portion, and stripping the future benefit we will book as a stripping asset portion. So allocation basis may be production ratio method, proportionate to the volume of ore currently mined versus the future ore to be accessed. So Hookage share the waste by tonnage. And subsequent measurement, we need to apply a 16 cost model or revolution model if adopted by the company, and we need to amortize the stripping asset systematically over the identified component of the ore body benefited. Usually it is based on the production units tonnage that we have mined. And if there is a impairment, we need to test the stripping activities for the impairment under India's 36 whenever indicator exists, and maybe based on the cash generating unit, mine or component of the mine fitting from the asset, and if there is a derecognition requirement, so we need to derecognize the stripping activity asset when it is fully amortized or there is no future benefit expected from the improved asset. So gain or loss on the derecognition we need to book in the P&L, and hook for it that when the layer is gone, the asset is gone. If there is a no benefit from the asset, we need to derecognize the asset as per the principle. So this is all about in day 16 that we have discussed with the examples. If you have any query, if you have any suggestion, if you want to discuss anything, you can discuss on the WhatsApp number given on your screen. Thank you very much for listening. Namaste.